Hey everyone, and welcome to Bigger Basics, today sponsored by Rent to Retirement. In today's video, I'm going to go over a few of the most important rules of thumb that real estate investors should know when they're buying deals or operating their businesses. Rules of thumb are not the be-all, end-all. They are not actually rules. They're actually more like suggestions, and you should always do your own analysis before making any type of investment decision. I'm actually going to share with you a brand new rule of thumb that I've been developing over the last few months, and I'm super excited to share it with all of you. Before we get into today's rules of thumb, we want to thank our sponsor for today's episode, Rent to Retirement. Did you know that short and medium-term rentals often offer double the cash flow compared to long-term rentals? Well, it's true, and Rent to Retirement just made investing in them easier than ever. Now you can buy fully turnkey short and medium-term rentals that are newly built, renovated, leased, and managed. Maximize your cash flow, appreciation, and equity, all of them, while the Rent to Retirement team takes care of it all for you. Plus, their creative financing options like interest rate buy-downs can get you a rate as low as somewhere in the 5s. And their investor loans let you buy multiple properties with as little as 5% down. That's not 20% down, I said 5% down. But why buy with Rent to Retirement? They're investors just like you and me and rock one of the highest reputations across BiggerPockets with more 5-star reviews than any other company on our site. To learn more, visit renttoretirement.com or text REI 33777 to learn more about how you can get started investing in some of the best cash flow markets today. So let's get to our rules of thumb. And just as a reminder, rules of thumbs are basically just ways to shorten some sort of analysis that you're doing. So one of the most common applications of a rule of thumb in real estate is when you're analyzing a deal, or maybe you're looking through property listings that your agent sent over. You just want to figure out which ones you should consider and do a full analysis on, and which ones you don't think are even worthy of any more time. And one of the most common rules of thumb that have been in place for about 15 years or so is something called the 1% rule. And the 1% rule is basically a way of testing whether a property is likely to cash flow or not. And to calculate it, you use something called the rent to price ratio. It's very simple to calculate. All you have to do is divide 1 month of rent by the purchase price of a property. And you're going to get a number that's probably between 0 and 1%. And the closer to 1% you are in that rule, the more likely it is to cash flow. So if you're at 0.6, 0.7, 0.8, you can probably at least break even or maybe cash flow a bit. If you're below 0.6%, you're probably going to have a hard time cash flowing with that property. So hopefully you can see why this is a pretty useful metric, because just by knowing those two numbers, you get a rough idea of whether or not a property is going to cash flow or not. Another major rule of thumb is known as a 50% rule. This is another way to test how much cash flow to expect. And this basically says that 50% of your income, your revenue, your rent collected should be spent on operating expenses. Operating expenses are things like insurance and taxes and property management, or things like paying utilities. Notably, operating expenses does not include debt service, like paying your mortgage, or capital expenditures, which are big things like paying for a roof or a new hot water heater or something like this. And so these two are really good ways where you can just sort of measure cash flow. Also, if you're a house flipper, there's another rule of thumb called the 70% rule, which basically says that you should pay no more than 70% of the after repair value for the property before you rehab it. But I have to tell you something. All of these rules of thumb, particularly the 1% rule, were invented during a very different housing market when it was a lot easier to find cash flow. And I've been thinking about this a lot and wondering if the 1% rule or the 50% rule are really still applicable in today's investing environment. And I decided that we actually need a new rule of thumb. And so I've been developing one, and it's called the 10% target. I've shared it with absolutely no one before today. So this is the first time I'm revealing it, and I'm going to explain it in just a minute, but please let me know what you think of it in the comments below, because usually when you come out with these kinds of ideas or frameworks, they need a little bit of refinement. And so I would love your input on how to make this rule better. So the point of the 10% target is to help you find the best risk-adjusted return in today's investing environment. And a lot of the other sort of rules of thumb that I talked about are great, but they compare real estate to other real estate, and we're going to do that too. But I think it's really important here to note that the purpose of the 10% rule is to find you the best use of your money today. And that could include something like the stock market or crypto markets. But I personally believe that real estate offers the best risk-adjusted return out there. If you're not familiar with risk adjustment, it just basically means that when you consider the return potential of a deal, you also have to consider the risk potential of that deal. So for example, cryptocurrency, huge potential for returns. There's also huge potential for loss. So what I'm trying to do with real estate is find a really solid return rate with relatively low risk. And that is what the 10% target is designed to achieve. There are actually 5 different ways that you make money through real estate. You can make money through cash flow, amortization, that's basically paying down your loan with revenue from your business. Third is value add, that's like flipping a house or the BRRRR strategy where you add or improve your property. Fourth is market appreciation, basically when your value of your property goes up due to macroeconomic forces. And then lastly are tax benefits. So the 10% target is really simple. It basically says that when you add up all of those benefits, again, it's cash flow, amortization, value add, market appreciation, and tax benefits, the total annualized return should be higher than 10%. Now, if you're wondering why 10%, it's because that is, to me, is better than any other risk-adjusted return that you can get out there. The stock market, I think, offers good risk-adjusted returns, but over the long run, it's averaged about 8%. And so for real estate investors, I think you should try and do better than the stock market and get 10% for a couple of reasons that I'm going to explain. First and foremost, real estate is active. It actually requires work. So if you're getting the same 8% in the stock market, which is very passive, as you were for a real estate investment, it's probably not worth your time. So to me, getting 2% better on real estate is worth the time and effort that real estate investing takes. And if you're skeptical that 2% makes it worth it, let me just explain something to you. In a hypothetical situation where you invest $100,000 one time, I know that's a lot of money, I'm just using round numbers to explain this point. If you invested $100,000 at 8% versus 10%, the 10% annualized return would get you a return of $738,000 more over 30 years. That's right. You take $100,000 and invest it, and if you invest it 10% instead of 8%, your return goes up by almost $740,000, or put in other words, a 73% increase, because that's the power of compounding. So that's why, for me, getting a 10% return is worth it. It's worth taking on the extra work of real estate to get that outsized return over the stock market. The second reason I think it's worth investing and spending the time on real estate is not just the 10% return, but real estate also offers a lot of upside for appreciation. And over time, real estate deals tend to get better, right? As rent increases, and if you have fixed debt, your expenses stay the same. That means that your cash flow and therefore your annualized return are actually likely to get better over the course of your hold period, whereas stock market returns just stay at the same old average. And the last cool thing that I want to explain about the 10% target and why I like this framework is because within this 10% goal, each individual investor can balance the 5 different ways of earning a return in real estate in ways that they like. So this example that I'm going to throw up on the screen here is actually from a deal I was just annualizing, and you can see how it came out. It has 4% cash flow, and for some people that might be too low. For me, I'm comfortable with 4% cash flow if it's in a really good neighborhood and there's good upside for appreciation. And so I'd say 4% cash flow plus 2% amortization, 3% value add, 1% tax benefits, and 2% from market appreciation. Well, when you look at that, we're looking at a 12% return. So that would pass the test of the 10% target, and it would have a little bit of cushion of an additional 2%. So when I think about how I can use my money, if I had the money to buy this deal, I can invest in the stock market and make 8%, or I can invest in this type of deal and get a 12% annualized return. And even though the cash flow is 4%, which some people might not like, you have to consider what else you can do with your money, not what cash flow was available 10 years ago. You have to deal with what's available today. And to me, this kind of deal is better than any other investment options out there. And I'll quickly just pull up the analysis to show you how I did this. So this is sort of a complicated spreadsheet that I use for my own rental properties. But as you can see, this deal was for 270 grand. I was going to put about 15 grand in it. Interest rate is about 6.9%, 25% down. My rent is $28.50. I've got everything accounted for here. That's super important when you do your analysis. You have vacancy rates. I have all of my capital expenditures that I'm going to need to make over time. Then I have my operating expenses that I'm going to be paying in. I like to analyze my deals very conservatively. So I put 2% for my property value increase and 2% for my cash flow. And actually, that reminds me, one other thing I wanted to say about the 10% target is that you can configure your own returns however you want. You could prioritize cash flow or appreciation in whatever way you want. But I recommend that you target at least 2% cash flow because you should have enough money coming in to cover your expenses and then provide a little bit of padding. That's my own personal investing philosophy. You can think differently, but for me, I think you need at least 2 of the 10% to be from cash flow. So when I come down here, this rates of return that I'm highlighting right now is what I'm looking at. So I can see that for cash flow in year 1, I'm going to get 3.4%. So that beats my 2% guideline there. Amortization, that's paying down your loan, is over 2%. Appreciation at just growing at 2% a year, which is the historical average, will get me 6%. And I actually roll in value add into appreciation. That's all one big target there. And then tax benefits is another 1%. So when I add this all up for my total annualized return, I have almost 13%, 12.86, which is why I would consider this deal a good one. And remember what I said before about deals getting better over time because of cash flow? Look at this cash on cash return here. It goes up over time, even if rent just goes up 2% a year, which is actually below the historical average. And so you can see my total annualized return goes from about 13% up to over 20% over time. So hopefully you can see that this is just an easy way to find good ways to use your money in today's economy and today's investing environment. And if you're curious, this is a deal that I found on the market in one of the markets I invest in. It's not any special deal. Not every deal is going to meet the 10% target. It takes, analyzing a couple to find ones, but this is an on-market deal that my agent sent me and I think is a perfectly viable, good deal that I would consider buying. Now, you might be looking at my returns, and I'll just throw up this pie chart again to see how this deal plays out. You might have different priorities than me. Like you could say, I'm going to look for a 10% target deal, but I need a 6% cash on cash return. And I really don't want to do value add, or I really want to prioritize tax benefits, or I really want to prioritize value add and I don't really care about cash flow. That's the cool thing about the 10% target framework that I'm working on, is that it allows you to be creative and to sort of customize the type of deals that you're looking for all within one framework. So I hope you like this new framework. I'm super interested in your feedback. Again, this is something I've just been developing over the last couple of weeks, and I would really appreciate any input or thoughts you have on it. If you are a BiggerPockets Pro member, I will throw the spreadsheet that I was just showing you in the resource center. You can go to biggerpockets.com/resources, and that is for Pro members. You can get that for free and start looking for your own 10% target deals. I again want to thank Rent to Retirement for sponsoring this video. And thank you all for watching. I'll see you soon.